Hello, hello. Hey, welcome to today's show. This is Mike Patel live on YouTube and StreamYard. And today's topic is nothing else but talking about loans and the federal rates that are hopefully going to come down on Wednesday. So let's see what happens. But before I get started, I want to welcome you here on my channel. Mike Patel is my name. I'm in Anaheim Hills, California. And it's a beautiful day today. It actually sprinkled in the morning. Last week, there was a lot of rain. Not a lot of rain, I'm sorry. There was a lot of heat out there. But today, it actually sprinkled, and there's some fires going on in Southern California, three big ones. So hopefully, the showers helped a little bit to our firemen, and kudos to our first responders. And hopefully, the rain will help them out. So I also have a guest today. So I'm going to, before I get started and talk about rates and lending and how it affects the buyers, how it affects the sellers, and the general home housing market, I want to introduce a guest. So let me bring on the guest. His name is Kevin. Just give me a minute. Kevin, can you hear me?
Yes, sir.
Good, good. So everybody, this is Kevin Jefferson. He is from Georgia. He's been in the mortgage industry for the last 20 years. I know Jeff from a group, online group that we belong to, and he's very knowledgeable. Not only that, he's very up to date with what is happening with the interest rate, and he's going to help us talk about and figure out how the federal interest rate cuts. Hopefully, they'll cut so that the mortgage rates go down. And before I forget, Kevin, if you can explain the difference between federal rates and mortgage rates, we'll talk about that because they're not the same, right?
Right.
So,
No, they're not the same.
right, right. So we'll talk about that. But hey, take a few minutes, Kevin. Explain who you are. Just let them know who you are, and then we'll get right into it.
So, like Mike said, I'm Kevin Jefferson. I am a mortgage loan originator. I've been in the real estate industry for 20 years now. I don't just play a mortgage loan officer on TV. I actually do the business. Um, I
Yeah.
currently reside in Georgia, and I'm here just to educate and help anyone who wants to know or dispel any myths about rates and different things pertaining to the real estate industry.
Right, right. Cool. Hey, so before we get started, can you explain the difference between the federal funds rate and the mortgage rates? Are they not the same, right?
Correct. Yeah, they're not the same. So the federal funds rate. So on Wednesday, Jerome Powell, the head of the Federal Reserve, will come out and determine whether they're going to raise interest rates or leave them decrease interest rates, not raise them. Please don't.
Yeah. Hope not. Yeah.
Decrease, yeah, decrease the interest rates or leave them alone. So when the Federal Reserve, which is a quasi government entity, per se, they do banking. It's your student loan debt, it's your personal loans, it's your car payments, it's your credit cards. When the Federal Reserve decreases interest rate, those things are affected directly, right? The mortgage interest rates are affected indirectly, meaning the rate could go down, but that doesn't mean your mortgage interest rate goes down because of those rates. However, once the economy starts to spur and we start to see things change, then there's an indirect effect on the mortgage interest rate. Just to give you a little hint, over the course of the last maybe 6 to 8 weeks, we've seen decreases in mortgage interest rates. Well, the Federal Reserve hasn't decreased interest rates, right? And when interest rates decrease, and let's say there's a decrease on Wednesday, that doesn't necessarily mean that your mortgage interest rate is going to decrease. So they don't have a direct effect. Most mortgage companies right now have cushioned in that change that they're going to make. So if it's an eighth or a quarter of a percent, you probably won't see anything change on the mortgage side because of we've already built it in. But what we will see change, Mike, is the amount of people who start applying because they've heard rates have decreased. but not knowing which rates have decreased.
Right, right. Yeah, and understand that since the last couple of weeks, I just had lunch this morning, and he was saying that he knows this lender as well, and his application for refi, he's getting more calls than the last few months because rates have dropped. So if somebody had 6.5 or 6.75, and now it's at 6.1, 6.2, is it worth refinancing if it's a half a point difference? I mean, he's getting calls on it, you know.
Right. So yeah, we have seen an uptick in mortgage refinances. Realistically, anyone who has purchased a home in the last 24 months, who has not used a builder, probably has not used a builder who is offering a low rate, probably can save money on their mortgage as it is, right?
Right.
Because interest rates are lower. Um, you you want to get prepared because this causes a couple of things, Mike.
Yeah.
It creates a storm in our business, in our industry. You have more buyers out that begin to start looking to purchase homes because now, shoot, you're in California, so the ones who couldn't afford 650 now can because the rate dropped.
Hmm.
So then you still have those people who wanted to be in 650 because that's where their payment needs to be,
Right.
and then you create more of a storm, right? Then you have people who've purchased in the last 24 months who can decrease their interest rate and they want to do it.
Right.
Well, the staff that we have does refinances and purchases, right?
Hmm.
Which means we're gearing up for the change in the market, but a lot of lenders aren't going to be able to handle that business per se to get it done as fast as possible, if that makes sense.
Right. Yep.
So
Yeah.
I have a client, he actually reached out to me. He said, "Hey Kevin, what are the rates?" And I, went through his file and I quoted him the rate. He said, "When the rates hit this, I'm ready to go." And I was like, okay. He was like, here's my application. I know we're not doing nothing now, but I don't want to be lost in the sauce when everybody else is
Right.
trying to apply. I've got my application in. You know where I want to be. Let's pull the trigger. So,
Right.
if I said all that to say, if you're out watching and you want to take advantage of these lower rates that are coming, I would start preparing. When I say
Right.
preparing, you don't even necessarily have to really do the application yet. You just want to get your documents together because speed wins. The faster
Right.
you can get them in, the faster we can approve you. The faster Mike can go out and show you houses and get you under contract.
Right. Cool. Great information. So when you say documents, what are the 3 or 4 main documents that they need to prepare so they're ready and they can make a note if they want to, you know?
Great question. So first thing is your most recent 30 days pay stubs. If
Mhm.
you are a W-2 employee, we need your most recent 30 days pay stubs. If you have 2 jobs, we need 30 days from both jobs, right? The
Right.
next thing is 2 months most recent bank statement, all pages, even if that last page is blank. So Kevin, biggest question is, Kevin, which bank statements do you need? I need the bank statements that show you direct deposit and the bank statements that have your funds to close in. Well, if
Hmm.
that's not a bank statement that has your funds to close in and it's in a 401k or IRA, I need that most recent statement because we need to show that you have funds available to close on your home, right? The next thing is if you are a W-2 employee, we need your 2 most recent year of W-2s, all jobs. So if you work 2 jobs or you've worked 3 jobs in the last 2 years, and you're still only on 2 or 1, we need those W-2s to put together a work history and show you have a consistent work history.
Right.
If you are a 1099 employee, we need your 1099 self-employee. We need your 1099 for the last 2 years. If you are a business owner and you want to purchase a home, we need your most recent 2 years of tax returns. So unless you file an extension for October the 15th, or actually, no, it was September 16th. It's today, I think, or 17th.
Is it?
For
Oh,
for business owners, yeah, you
oh, I
have
thought it
to
was October
provide,
15th. Oh,
huh?
I thought it was
October
October
5th.
15th. Yeah.
I think October. I believe October 15th is for personal taxes.
Huh. Because uh, I haven't filed my taxes yet. I'm waiting for a K1. I've got a company that I've invested in. We haven't received K1s yet. I better
K1
call my
yet.
accountant today. So anyway, we'll be
Got
late. We'll pay penalty in that case. So
you.
yeah.
And then you need your most recent driver's license, unexpired. And you may say, well, why would I have an expired driver's license? Yeah, I get them all the time. Like people forget to go renew their license.
Right.
Um, so those are the pertinent, important documents:
Right.
driver's license, a social security card, and or a passport.
Right.
Two most recent tax returns if you're self-employed or a 1099. If you're not self-employed or 1099 and you're a W-2, I need your most two recent years of W-2s, your two most recent months of bank statements with
Hmm.
all pages. I
Right.
need your most recent 30 days of pay stubs. And please, this is very important. We cannot accept screenshots, pictures of the screen, or pictures of your documents. They need to be
Right.
PDFs.
Right. Okay, cool. Okay. Well, let's switch some gears. I was looking at an article today, and of course, we're going to talk about buyers right now, what they need to get a home, how the interest will impact them. Later on, we'll also talk about how the interest rate, whether it goes up or down, will impact the sellers and also the seller's home valuation. So let's come back to the sellers, but let's go back to the screen. I'm going to share a website. Hopefully, you can see it, and let's talk about that. I saw this article today. It's from not today. I saw the article today. It's from the National Association of Realtors. Can you see it? It says
Yep.
the upcoming rate cut, and this came out on September 10th, so just a few days ago. 5 things homebuyers should consider. So we can read this article, but I wanted to get your opinion, Kevin. What are some of the 4 or 5 things, or 3 or 4 things that the buyer should prepare? I know one of the things is your documentation. But what are a few other things that are key in this market that you are seeing, not only in Atlanta, because I understand you do loans all over the nation. What are you noticing, and what quote information can you give the listeners, whether they're live right now or they're going to look at this video after we put it on YouTube? Some of the things they should consider when the rates cut, and if they're thinking about buying or refinancing.
Right. So I'm glad you asked this question because probably a few hours ago, I just had a consultation with a couple. First
Hmm.
thing, if you're a couple, you need to be on the same page.
Okay. What do you mean?
What I mean, what the wife expected and what the husband expected to do were total opposite ends of the spectrum. So,
Oh, okay.
in order to example, she wanted a mortgage payment no more than $3,000 a month. He wanted a 700 and some $1,000 house. Those aren't the same thing.
No, absolutely
They,
not.
yeah, they're not the same thing. So that's one thing. To whoever your partner is, make sure you're on the same page, which is key because it cuts out on the delay. So
Okay.
now they've called me
Right.
and they're interested in a mortgage, but because they can't agree on what they want, they don't do the application. So there's a delay.
Delay. I see.
Um, so
Okay.
definitely be on the same page. The next thing is to, um, have, of course, have your documents and your most recent documents, but also to have an idea of, where you want to live, who you want to use, where you want to live. That's another thing. Like
Hmm.
being flexible and having an idea. If you qualify for $600,000, but you were looking for in $1 million community, you're not going to find that house in that community. So you have to be flexible with where you're able to go.
Correct.
The next thing is I would probably start trying to see who I'd be interested in using as a real estate professional. That is key. Like you need to have a knowledgeable agent who's familiar with where you're looking to live and the market. and who can also help you get your deal to the table.
Hmm.
Why is that key? Because if you're applying and you're looking in a market where there have interest rates have dropped, you're not only just entering the market, tons of other people are, and instead
Uh-huh.
of it being one offer on the property, you're looking at multiple offers.
Right.
Yep.
Okay. So
Um,
that's a very important point that you bring up, that make sure you work with the right realtor. Now, what if I'm brand new, I'm a first time buyer, I don't know anything about homes, I don't have friends or brothers in this area that have bought that can refer me to an agent, to a realtor. If I was a first time buyer, from a lender's standpoint of view, what would you tell the buyer? To what kind of realtor would you look for, and how would you look for the realtor?
ooh, that's a great question, man. That's a tough one. It is a tough one. So, I would definitely go online and I would look up top real estate agent and let's say Orange County, California,
Hmm.
right? Or real estate agents in Orange County, California. If you hone into a specific town or area, real estate agents in a specific town of Orange County, California. And
Hmm.
I would look at their reviews and I would also call them. Now, what buyers don't understand is agents are interviewing you, but you have the opportunity to interview them as well, right?
Mm,
So I would interview them as well. Another thing is, let's say you come across a lender first and you
right,
get pre-approved, but you don't have a realtor. Ask your real estate, your mortgage lender, if they have a referral for someone in your area, because if they do, they typically have worked with that person and they know that they're going to be able to help you out in that circumstance, right?
right, right,
Another, yep, another way is to ask coworkers, hey, realtors do a great job of advertising themselves and letting everyone know what they do. So everybody knows a real estate agent. You know what I mean? Even
right,
if it's in a
right,
different area, right? That's another way. And then if you're in a new area, your mother, brother, sister, family don't know an agent in your area, maybe you knew a realtor in your hometown, ask them if they know anybody where you're at currently,
right.
and maybe get a referral that way. Those would be the ways that I would do it. So,
Correct, correct.
example, I didn't know anyone in Georgia, so I
Right,
went online and Googled real estate agents in Gwinnett County, Georgia, and three came up. Three came up. I called all three. I called all three. One answered the phone. The one that answered the phone, I asked her if she could refer us to a mortgage lender because I didn't know any mortgage lenders in Georgia either. She
right.
gave me three. One picked up the phone, and here we are
Yep.
today. So,
Yeah.
Google's your friend.
Google's your friend, and then people who answer the phones. One of the key things that I do, and not talking about myself, is that pick up the f- pick up. I'm going to use the word, but I'm not going to use it. But see what I'm saying, because the one of the biggest complaints, according to National Association of Realtors, one of the biggest complaints from buyers and sellers about their realtors is that they don't pick up their, you know what I'm going to say, phone. So pick up that phone, and if I do the same thing when I'm doing a referral, and I do a lot of referrals from this show and from my YouTube channel. People call me and say, find me a realtor in Texas or real Atlanta or Florida. And what I do is I pick two or three agents in that neighborhood. I call them. Whoever answers the phone gets the business. Of course, I interview them, check them out, make sure they have experience, they're reliable, they sound honest, etc. But you pick up that darn phone, because most realtors don't pick up the phone. In fact, these days it's so bad that when you call them, they say, text me. Well, you had time to text. Why don't you just answer the phone? So that is ridiculous. So anyway, that was on a side note, but I thought that was important. But to carry on, Kevin, if you had some more points.
No, I think those are the biggest points. Your sphere of influence, even if they're not in the area.
Hmm.
A real estate professional that you know outside of the area that you live in. Um, Hitting up, someone on Google or
Uh-huh.
Yahoo, whichever you look up, or
Right,
YouTube. You can
right.
YouTube a lender. If
Yeah,
you
yeah.
YouTube a lender in Georgia or United States, I should pop up. If you YouTube a real estate agent in California, Mike should
Right.
pop up. So using YouTube as well,
Right.
those are ways to do it.
Yep.
And then just referrals from other realtors or friends from back home.
Correct. Okay. Cool. Okay. Thank you. And I'm going to share another screen. Let me see. Can you see it?
Yes, sir.
So the big news has been rate cuts, rate cuts, rate cuts, and I think the rate cuts are coming on Wednesday. Is that right? From Jerome Powell is going to announce it on Wednesday, this
The
Wednesday,
18th, right?
18th. Right. Today is the
Yep.
16th, I believe.
Yep.
Yeah. So the question is, and here's an article that's a couple of days old from USA Today. How much will they cut? Fed rate decisions may be the biggest economic news this week. What does this mean to you as a lender? Because you know the industry. How much, how important is this, and how much impact will it make in the next quarter?
It will make a huge impact. It will if the federal I believe if the Federal Reserve makes a cut to interest rate, which will and when they cut interest rates, it's not a ton of points. It's something called a basis point, which is equivalent to if they do 25 basis points, that's a quarter of a dollar, right?
Right.
Quarter of 1%, right?
Right.
It changes your student loans. It changes people who can do home equity lines of credit. Your credit card interest typically will go down. More
Hmm.
people will potentially be buying cars. All of those things happen, and it spurs the economy. Not only does it spur the economy, it allows for people who were stuck with higher rates on any of those things to refinance and get a lower rate, which allows for them more of a cash flow, which then can entail give them more cash flow to be able to buy more of a house. So those
Right.
rates dropping help with inflation, and it also helps with cash flow, which then allows you to flow over and be able to purchase more home because you have less personal debt.
Right. Right. Okay. So this chart shows how interest rate traders bet the Fed will cut rates. I mean, it shows. I don't really want to get into it, but you probably know more. This is a recent chart. It shows the expected cuts on Wednesday and the probable range by June 2025. Do you want to talk about a little bit to explaining it to a first-time buyers or even guys like me? I do mostly sales. I don't get into real estate, but if you can just talk about this chart, what it means or what we should expect in the next 3-4 months or even next year, you know.
Right. So what we'll see is a constant. If they cut rates, they'll constantly start to cut rates. What they're looking at is inflation. Is the inflation where we need it to be, and are the jobs where they need to be, where we can begin cutting rates? And I know this is going to sound backwards, but they're looking for a certain percentage of jobs to increase, but they're looking at inflation to decrease and be somewhere around 2%. I want to backtrack, right? At the end of 2023, they announced that they would potentially be cutting rates 3 times in 2024. Well, we have yet to have a rate cut.
Right.
And now the economy, contrary to what people potentially believe, and I'm pretty sure when I make this statement, you'll get some comments, but it's just the
Yeah.
truth.
Right.
The economy is somewhat getting better, and inflation is getting better, right? The eggs are no longer $6 over here. They're 5.50
Right.
for
Right.
a dozen. So
Right.
we're starting to see, inflation go down, more jobs being available, and people starting to have more disposable income, and uh, that allows for you to have a better economy.
Right.
Now, what the inflation numbers are based off of is not what's happening or how it changed from last meeting to this meeting. It's what changed from September 17th of 2023 to September the 18th of 2024.
Mm.
So all of that has to happen over the course of a year. It's just not from meeting to meeting. They're looking at the
Right.
change year over year.
Right.
Um, for example, in the last month, gas has went from 3.30 here, and I saw it for 2.75 yesterday at the same gas station. So
Right.
things are coming down. I do the grocery shopping in my house.
Okay.
I was rather surprised that, the price of bread has come down a little bit. Have they taken out a few slices? Possibly, but the price of food and groceries have gone down in some of the major stores, and they've probably made adjustments and changes, but all of that helps with inflation. All of that helps with people being able to spend more money. So when we see the Federal Reserve cut rates, it affects the economy. It affects the economy, and the next time they meet before the end of the year, they will be looking at how the economy changed and how inflation changed from that date of last year in 2023 to 2024 to determine whether we're going to have another rate cut or not.
Right,
So those things play important parts, and it's year over year, not necessarily what happened from last meeting to the current meeting. Hopefully
right.
that made sense, Mike.
Oh yeah, it does make sense. It's pretty much detailed. So I know one thing, two things. One, you said that the inflation is down. Well, 3 4 years ago it was 8%. Right now, isn't it under 3%? It's a
Yep.
2.51,
Yeah, it's
2.7.
under three. It's close to
Employment is
two,
high
man.
too. So are we there, or we still have some room to go as far as the rates goes? Because inflation is way down. And of course, inflation was high. Several reasons. One, house prices were up too, because that counts in inflation. Gas prices were ridiculous because of the oil shortage and all that. So that accounted for that too. And like you said, even in California, we've seen a drop in gas prices. Summertime or pre-summer, we were at high five, $6 per gallon, and now we are under $5 per gallon. Yes, eggs have dropped over here. There's no longer shortage of eggs. You can find eggs. So things have dropped. Um, one of the questions that I had, I was going to ask you earlier, which I did not, is that you mentioned that Jerome Powell and the Feds will cut the federal funds rate, and then the mortgage rates may follow, may not. So the question is, who decides how much the mortgage rates are? Is it the combination of these bankers, mortgage bankers association, or lenders, banks? How is that determined?
So mortgage rates are actually determined off of treasury bonds.
Okay.
And so the T bills, the treasury bonds determine how mortgage rates do, right? Are
Hmm.
people buying them? Are people buying mortgage backed securities? If there's a demand for mortgage backed securities and people are buying it and taking that debt off of servicers such as Fannie Mae or Freddie Mac, or if they're buying, then that allows for them to have more disposable income to lend more money at a cheaper price
Hmm.
because people are buying those things and they're trying to gather more. So some days you'll hear that the interest rate has decreased and the stock market has tanked. There's days that you hear the interest rates have decreased and the stock market has done well. Sometimes they all have a direct effect on each other. Sometimes
Right.
they don't have a direct correlation. But what I do want people to understand is when we say that interest rates are potentially going to drop, or they change daily, sometimes multiple times throughout the day. So since 10 o'clock this morning Eastern Standard Time to probably the last time I looked, probably somewhere around 3 o'clock, mortgage interest rates have improved twice. What
Hmm.
does that mean? That doesn't mean that the interest rate went from 6% to 5.5. That means to get that 6%, it might only cost $2,000 versus 3,000.
Hmm.
Or to get, when you hear someone talk about buying down rates, that may mean, okay, for that same $3,000 that I was quoted this morning, instead of it being 6%, I can go to 5.75 with the same money that I was going to spend anyway, and I'll have a lower payment because my rate's lower and I pay. So over time, right?
Right.
So those things count, and rates change consistently every day. At some point, even though the rates are dropping, sometimes we see pricing for the worst. So Friday, I think I seen pricing for the worst once. And when they change at the eighth of
Hmm.
a point. So point one two five.
Right.
Point 125. So there aren't huge changes, but it does help in the market by people having to pay less and then being able to use that same $3,000 that they were looking to spend anyway to get a lower interest rate to save them money over the long haul.
Right. Right. And I think as a buyer, they should also keep in mind, because I talk to a lot of buyers and say, well, my FICO score is 690, and when I say mine, I'm talking of a typical buyer. If my FICO score is 690 and there's another buyer that I'm working with, his FICO score is 780, right? Isn't there a difference in the mortgage rate they get too, including the debt ratio? If you want to talk about that, how it affects the points.
Yes. So typically so if you give me some time, I want to explain something a little thoroughly, right?
Go ahead. Go ahead.
So interest rates are not only determined by your credit score. It's determined by credit score, program you use, how much money you're potentially putting down, and what your debt to income ratio is. Also, how much house you can buy. So if you're in an area where you're looking at a house below $250,000, your interest rate is probably going to be a little bit higher because the bank or the servicer or investor doesn't make as much money off of that deal.
Mm-hmm.
What you also have to realize is because the house is lower, doesn't mean the interest rate is going to be lower because those companies still have the same manpower and hours into the loan, whether it's 100,000 or 700,000. In order for it to be appealing, typically they're looking at loans over 250. That gives you something called LLPA's, loan level pricing adjustment. When you have a credit score, with FHA, you can do a 580 credit score. You're not going to get the best
Right.
interest rate and the best terms, right? But you
Mhm.
can do it.
Right.
You can do it if it gets you into a house, right? You
Yeah.
start to see better pricing when you get to the 640 mark, $250,000. When you go, and it goes up in increments of 20 points on your credit report.
Hmm.
So if Mike had a 620 and I had a 619, his rate's going to be better than mine.
Hmm.
If Mike had a 620 and I had a 625, we're going to be about the same in rate. But I also want to tell you the same thing I tell clients. If we can get you to that higher rate, it works. It helps, right? I mean, to the lower rate, I'm sorry. I mean,
Right.
the
Lower.
higher score, the
Right.
higher score, we can do it. But there also has to be a breaking point where it makes sense. Meaning, if it's going to take you 6 months to get to that 640, it doesn't make sense because you're probably going to be paying higher pricing and purchasing the home, so you're not going to see the savings of the rate anyway.
Right.
So I would tell someone, okay, let's go ahead. Are you comfortable with this payment? Yes. Are you comfortable with the rate right now? Yes. Let's purchase the home and in 7 months see where rates are and we can possibly refinance you. That's how, because you want to get the house, because the difference that you save between now and 7 months off the rate to me is greater than paying more on a house, and then you've got higher payment, more down payment and closing costs required because the house that you were looking at that was possibly 550 is now 575, 580.
Right.
So those things help. When you have a 740 credit score in the mortgage world, that's considered top tier, and you typically get a credit, a loan level pricing credit, because you have a higher score, lower debt to income ratio, and then if your house is in a specific pricing point because they can make more money off of it, you get an adjustment. So I'll give you an example what I mean, because that may sound like a lot.
Yeah.
Before, like right dead smack in the middle of when rates started to change, like 6 to 8 weeks ago, I had a client was looking at $600,000 house, 797 credit score, and when the average buyer was looking at 6.25, he was quoted at 5.75 with no point.
Big difference. Wow.
Big difference, right?
Huge. Yeah.
But he
Yeah.
already had that profile established,
Mm-hmm.
right? Um, I had, so those things, having higher scores do help, but it's easier said than done. I just had a conversation with an agent and I said, everybody's got 700 credit score until you pull it. We all think
Right. Yeah.
they all think it's 700 until you pull it, and getting a 700 score isn't as easy as you think. So there
Okay.
are benefits to buying higher priced houses. There are benefits to having a higher credit score. If you have them, it gives you a benefit now, but that doesn't mean you shouldn't buy a house until you get a 740 credit score or can
Exactly.
afford a yeah,
Right.
six
Right.
hundred
Yeah.
thousand dollar house.
Yeah, and
Yep.
on that note, I also want to mention that if you do have a low credit score and if you can wait 2 or 3 months, there are repair credit companies. I have access to it. Kevin has access to it. And also on that note, if you are looking about thinking of buying a house or even selling a house in any area, if you need a referral, we have a network of agents, credit repair companies, lenders nationwide. Kevin does it in 50 states. So let us know. Direct message me if you're looking live. Send us a message. If you're looking this video afterwards, just make a comment and we'll help you out. My job here is not only to educate you, but also connect you. Even if you have just questions, you don't have to buy and ask for referral. If you just have questions or thinking about buying 2 years from now, what are some of the things I need to do? My credit is bad right now, 680, for example. How can I bring it to 740? So if you want to start preparing, hit us up and we'll help you out. That's our job. So just keep that in mind.
Great point, Mike.
Yeah, yeah. So I want to look at this screen again. I put it up and we didn't talk about it. And it says here this is like from September 12th, the rates were 6.2%. Where do you see, and of course, this is a tough question and you don't have the crystal ball. All indications are, and this is based on what all the indications are, people, myself, all realtors, all lenders, all buyers have been waiting for a rate drop. And I'm talking about mortgage rate drop, not the federal funds rate. Assuming that the federal funds rate drop it Wednesday, if not, the whole world, USA is going to be mad. How low do you think the rates could go by the end of the year? I mean, based on
Realistically,
your conversations with buyers that you talk to and lenders that you talk to.
I believe we can see low fives. I
Wow.
mean, low fives, low fives, low fives is probably where we could potentially see. And what does
Mhm.
that do? That brings in, if I'm not mistaken, I think that brings back like 4.5 million people back into the market.
Right.
So
4.5 million people to the market.
to the market,
Right.
low five is
Right.
where I think we'll potentially be. And I think that don't try to time it either. Because your situation could change. When you
Right.
apply, you may have created more debt and your rate isn't going to be as good as you think it should be. But I
Mhm.
think when the feds drop the rates, I think if they I'm hoping they make a cut. I'm
Yeah.
I'm hoping they
I
make a
think they
cut
better
for
because
Wednesday.
everybody's been expecting it. Everybody waiting and waiting and waiting. So
Yeah.
hopefully let's wait and see on Wednesday. So if let's switch some gears now. I want to talk about the sellers because one, we have a shortage of homes for sale. One of the reasons is obviously interest rate. And you might think, wait, how does that make sense? But if the interest rates are high, take my example. I'm not going to sell my house, but I have a 3% interest rate fixed. I got a 15-year loan 5 years ago. So I'm not going to move because I'm not going to move from a 3% to a 7% interest. So I'm not going to move. So interest rate does matter if you're a seller, because if I don't put my home for sale because the rates are high, that means a house is not coming on the market. And me as a seller, I'm not going to buy another one. Right. So
Right.
how much of an impact has the high interest rate made on the shortage and to the buyers? And if the rates drop, how much more impact will it make moving
If
forward? I mean, thinking as a
thinking from a seller
seller
standpoint,
point of view, right?
yep. So, if rates drop to the five, that may allow for more sellers to put their property on the market and they'll be
Right.
able to move. Um, Two reasons. One, to take advantage of the equity that they have in their property.
Hmm.
Two, for them to move to where they may really want to be because the difference between what they could potentially put down and then them buying down the rate could get them back close to their um current payment or rate that they want to be at, right? At
Mm-hmm.
the end of the day, nobody wants a mortgage. We want
Right.
the house. We want the
Right.
house. The
Yeah.
mortgage just happens to come along with the house if you don't have the cash to pay for it.
Right.
I think that will, because Mike, what we see now is houses staying on the market longer,
Right.
even though right now interest rates are going down, but we haven't seen a substantial drop in housing prices. So
Mm-hmm.
how do we stave that off? The interest rates coming down, and then sellers putting their houses on the market because they can move. We
Right.
also have seen record levels of inventory. And I don't know if you know these statistics, but in 20, not 20, in I know June of this year, 56,000 contracts terminated.
Correct. I heard about that. In
That
fact, I did a report
that
on that, especially
yep,
in
that
Florida.
was
Right. Right.
yep, that was the highest in history.
Mm-hmm.
Like in terms of percentage, that's 15%, which means it could have eventually affected 112,000 deals because there was sellers and buyers on the opposite side of those transactions. Um, so it brings more inventory. It could
Mm-hmm.
allow for sellers to it brings more inventory. It could allow for sellers to put their house back on the market, or it could allow for more buyers in two ways because now the seller says, "Hey, I want to keep this 3% interest rate. I'm gonna rent this house out, and I'm still going to buy." So
Right.
because the rates are lower, I don't want to get rid of the 3%. So it
Mm-hmm.
could bring more buyers, but I think it will affect inventory some. The other thing it affects is incentives. So right now, builders are giving huge incentives to get people to buy. I think when we start to see rates back in the fives or a little low, if they get a little lower, I think we start to see those big builders pull back on those incentives.
Yeah.
Also with sellers, they're putting their house on the market. If it was just if someone was making one offer on your listing, your seller may be apt to give more closing costs. But if there's five offers, then they can say, "Hey, we don't have to give any closing costs. Let's do highest and best."
Right.
Yep. So it affects the amount of money that borrowers could potentially be bringing to the table as well.
Right. Right. Yeah. Yeah. And I'm looking at a chart right now. You're talking about home sales. During in July we had almost 5 million homes sold in July 2022. If you look at the left, a year ago we had 4.1 million homes sold, which is a lot lower than 4.9. And I believe in 2021 there was 6 million homes sold. So we saw a big drop from home sales. Obviously, interest rate had to do with it, but also a lower shortage supply. Um, do you feel that we will see a significant increase in home sales if the rates go down? Right now, the projection is, we may have about 4 million homes sold in 2024, maybe a little bit higher than that. And interest rate has a direct impact on sales because I have a few of my buyers in Orange County. The medium price range is around $1 million. My buyers
Mm,
want to buy something decent, right? 4 bedrooms, 2 bath, 3 baths, 2,000 square feet, but there's nothing available unless you spend $1 million. But they don't make that kind of money, so they have to buy something for 800, $900,000 because the rates went up. At 6.5, they could not afford the $1 million home, but now with 5.5, they could afford the $1 million home. So, do you see the big impact that rates has on number of home sales, not only affording it, but also the number of home, like you said, when a seller sells a home, there's a buyer buying a home. So there's two transactions.
right. Yeah, it does have an effect, but the other thing is we're already short. I think 4 or 5 million homes for what the
Right,
buyers that we have.
right.
Um, you know, I, so maybe not a topic that we were going to discuss, but it just popped in my head.
Uh-huh.
Um, I said the same thing when President Biden put out and the thought of an incentive for first time home buyers, the first generational home buyers, right? The
Hmm.
$25,000. Well,
Right.
Vice President Harris is wants to offer the same thing. I believe that those incentives should also be looked at on sellers because then that allows for them to sell. That gives them a credit if they're over the capital gains tax. It gives them an incentive to put that house on the market, not only just the sellers, for people who have homes on the market. So listen, statistic, we're, let's say, 5 million homes short of houses. In the United States, there's 15 million vacant homes today.
15 million?
Incentivize those 15 million.
Wow.
Incentivize those people who have vacant homes to be able to fix up those homes, figure out, pay off those municipality liens, or do something that gives us more inventory to give us more housing. Those are the two places I think the incentives should go. There's a ton of
Right.
first-time home buyers and down payment assistance programs.
Right.
Incentivize the people who have the inventory to get rid of it.
Right. Hmm. Yeah, quite an impact there, So talking about something else, of course, when you're a buyer, you want the lowest interest rate, but before you want the lowest interest rate, you want the lowest home price. It's a given. If I'm a seller, if I'm a seller, I also want the lower interest rate when I buy. But before that, before I even thinking of buying, I'm thinking about the home valuation. Hey, how much is my home worth? So when the rates drop, if the rate is 6.5% and now it drops to 5.5%, how will that affect the value of my house as a seller? Does the rates have any valuation as far as me selling my home and buying something else, whether it's my house or overall homes that I'm looking for?
Not directly.
Okay.
I think indirectly, because we've got more buyers, so it's more offers. So instead of getting, 650, you might get 670 because
Right.
someone's willing to offer over. But because rates go down, it's not an automatic given that the price of your housing will go up immediately. As you get
Right.
more sales and comparables in the area, then you'll be able to see some appreciation. But that takes time, at least 3 to 6 months before you'll see that.
Right. Right. Okay. Got it. Yeah. Yeah. It doesn't have a direct impact, but if I'm looking for, like if I'm a buyer, so maybe it will not affect my home value, but when I look to buy something, let's say I want to move to Florida, and I say, you know what, my current rate is 3.5%, but my mom is really sick. She's in Florida, so I have to move to Florida. Rates are 5.5, which is better than 7%. So I may move because of that, because 5.5 is better than 7, and that could be 300, 400, $500 a month payment difference depending on the price of my home. So it does make a difference,
It's a
um,
huge difference.
a
But
big difference, because
big
hey, if
difference.
my mom is sick and if I have to move, I have to move, right? I mean, um, you know. So here's another thing I want to talk about is that regardless of the feds are going to drop the rates or not, the market rates are going to drop down or not, whether it's 5.5%, 6%, 6.5%. If I'm a seller, want to sell my house and have to move to Florida because my mom is sick or whatever reason I have to move, and I really want to sell the house, how can me as a seller make it more attractive to a buyer to buy my house when it comes to payments or interest rates? What are some of the things I could do or possibly do that I've never thought about?
First thing is potentially offer some closing cost assistance. Meaning if the buyer needs, you know, $15,000 in closing costs and they ask you for 8, possibly give them 8. If they ask you for 10, give them 10, right? Helping them be able to have the money in on the transaction, right? That's one way. Let's say the feds don't drop the rate and we're still waiting, offering something called a buy down. So they have a 1-1 buy down, 2-1 buy down, 3-1 buy down. I'll explain. So let's say you come to me as a lender and I say, hey, Mike, based off, what we're looking at now, your interest rate is going to be about 6.25%, right?
Okay.
And you say, Kevin, I wish, that payment's high. I'm already buying a $900,000 house. Like, is there anything I can do? So we can look at pricing and we can say, okay, instead of asking the seller, instead of using that money that the seller is going to give you for closing costs, use that to buy your interest rate down for 1, 2, or 3 years. What does that mean? If it's for 1 year, instead of it being 6.25%, For that 1 year, your payment is 5.25%. If it's 2 years, then instead of your first year payment being 6.25%, the first year payment is going to be 4.25. It will change on the second year to 5.25, but it will never go higher than what you were qualified at, which is 6.25. What does that do? That alleviates some of that payment shock. And what you can do is utilize that opportunity to, when rates do drop, you can refinance your loan
Right.
and then get the lower interest rate and lock in. So example, I've got a past, well, she wasn't even a client. She applied with me, but I couldn't offer a deal for her or a buy down for her. So when she went with new construction, they offered her a buy down and money. Well, we couldn't compare. She reached out to me and said, "Hey, my rate is adjusting to XYZ in January. When rates hit 5% or below, call me. I want to refinance." Because even if she locks in at 5.25, it's going to save her money from that 5.99% that she was going to lock into for the rest of her loan.
Right. Right. Okay.
Yeah.
Now, just a word of caution, you can only refinance when you refinance. Let's go back to an FHA loan. And I know you do a lot of FHA loans. So let's say I buy a house for $400,000 FHA. I put 3.5% down. Seller gave me $5,000 in closing cost at 6.5% was my rate. Next year, the rate dropped to 5.5%. Can I still refinance that, or does it have to be like a loan to value ratio factor when it comes to FHA or other loans? How does that explain that to a potential buyer,
So
please?
there's a couple different things you can do on the FHA
Mhm.
refinance. If you have 6.25 interest rate, you could do something called an FHA streamline refinance, which is where we just pull your mortgage history, showing that you don't have any lates in the last 12 months. And then we just we give you adjustments for taxes, insurance, and all that stuff, and you can just go from 6.25, and let's say the rate was down at 5.25, then you can adjust a few things. In some cases, you can keep your same terms that are left on your loan. So if you
Mhm.
had 27 years left on your loan in 6 months, we could potentially put you in a product that allows for you to keep that amount at 27 years and 6 months. You could do a FHA rate and term refinance, which is different than the streamline. The difference between is we need a hard credit pull, we need an appraisal. You can't get back more than $500 in cash in your pocket, but you can pay down debt.
Hmm. Okay.
Which, hey, I've seen people do a rate and term refinance. Their mortgage payment didn't necessarily change significantly, but they got rid of some small debt that
Right.
would change. So they're saving money over
Right.
time.
Right. Okay.
Then you have the option of cash out refinance.
Hmm.
Cash out refinance is hard credit pull, income, asset verification, appraisal, and then you have the ability to either pull out the cash, pay down debt, a combination of both, right? That
Right.
takes 30 days. The rate and term refinance typically takes 30 days. But the biggest thing that I want you guys to understand is you cannot refinance unless you have owned the home for 210 days
On FHA.
on an FHA loan and VA.
Okay. Right.
Yep,
Okay.
200. You have to have ownership of
Right.
210 days before they allow for you to refinance your home. So if you just closed in August, you got to wait 7 months.
7 months. Right. Which is,
Yep,
I mean, it's going to happen anyways. What about when it
yep.
comes to conventional loan? Let's say I bought a house for $1 million in Orange County. I only put 10% down at 6.5%. After 6 months, rate drops to 6% or 5.75% or whatever. Can I still refinance with a
You
10?
can refinance. You can see about refinancing, but what you want to make sure is you want to make sure when when a borrower refinances, there has to be a net benefit to them. A net
Explain that.
benefit,
Okay,
a
what's that?
net benefit, yeah, that means they're not just refinancing to be refinancing because it's a way for a lender to get more money. They have to be some type of rate reduction, has to be like at least a 0.5% rate reduction. There also has to be a reduction or no mortgage insurance. Their payment has to be a payment reduction. Like it has to be a benefit to them. If they're pulling out cash and they need to pay down some debt, that's a benefit to them, right?
Okay,
So there
right.
has to be a benefit to them. So sometimes rule of thumb, most people don't refinance unless the interest rate has dropped at least a percentage point. So if they went from 6.25 to 5.25, it begins to make sense. And then the other thing is, does it make sense? Because on a refinance, on a rate and term refinance, cash out refinance, it typically costs money. It typically
Right.
will come from the equity in the property, but there's a cost associated with refinancing, so it's not free. So the money that you invest into it, you have to make sure that you're able to recoup it in a certain period of time. So if you're only going to stay in a house for a year and it costs you $10,000 to refinance and you're saving $200 a month, it doesn't make sense.
No.
So
Okay.
all of those things have to make sense.
Right, right,
So there has to be a net benefit to the borrower when they're refinancing. It could
right.
be a rate reduction, and it's a significant change in the rate, and it has to be a change in potentially if you went from like for instance, I got a couple who's looking to refinance. They're going from a second home which they purchased to a FHA loan, then that's a benefit because they're able to get a better rate because it's a primary residence now versus a secondary home.
Right, right. Okay. Yeah, a lot of
Yeah.
things to consider. How about how does the appraisal factor comes in when it comes to refinance on a conventional loan? Because I heard that you got to have 75% or 80% equity. And what if you don't have that within a year or 6 months or so?
So you got to have at least 80%. You have to have 20% equity in your property to refinance a primary residence.
Hmm.
And what that does is that allows for you to get rid of mortgage insurance, which is the big private mortgage insurance, which is a big thing that people definitely don't want to pay. Well, they don't want to pay. I'm not saying definitely, but
Right.
they don't want to pay. And sometimes, depending on your property, your asset, and you as a customer profile, you can get something called an appraisal waiver, where you don't even have to do an appraisal on the property. And that's through
Hmm.
like Fannie Mae on
Right.
conventional loans.
Okay.
Yep.
Okay. Got it. Okay. Um, Now the next question that came across, somebody asked me this question earlier, few days back, is that should you downsize in a high interest rate market? If I really want to buy a house, and of course, qualification comes in. So if I'm looking for $400,000 house at 6.5%, and now the rate goes to 7% or it lowers, how do I adjust purchasing power when the rates go up or down?
Um, if you want to you want to downsize in a high interest rate environment, you could if you can afford it. And then once you have the house, as long as you stay um, mortgage ready, you can refinance and get a lower rate. You can do a rate and term refinance with
Right.
conventional financing. You can do what you call a VA EARL, which is a rate reduction, FHA streamline. So you can reduce that rate um, when you're in that type of environment. I'm a
Right.
big proponent of if you can get the house, get it, and
Okay.
then
That's what I
they're going
say. Right. Right.
to they're going to adjust at some point.
So that leads me to the next question, and it's probably going to be the last question. And that comes across a lot. And, the question is why you should not wait to buy a house. If you really want to buy a house, you've been, quote, dying to buy a house. whether it's 6% or 6.5%. Why does it hurt? I have my 2 cents, and I'll give them to you also, but I want to get your opinion as lender. Why does waiting for a house to buy or waiting for a house to buy based on interest rates hurting you in the long term? What would you tell a typical buyer that if he's doing that or she is doing that?
So it depends. Like if you're looking to buy and you need to buy a house because your parents are moving in,
Mhm.
your needs are getting bad and you can't go up and down steps and you need a rancher, but you're trying to wait for rates to go down. To me, that doesn't make sense, right? I'd much rather be paying free and pay a little bit more for comfort than to be going up and down steps or sleeping on the couch with a bad back and bad knees, right?
And this happens all the
Um,
time, right? This happens all the time.
it
Yeah.
it
Yeah.
does. It
Yeah.
does happen. Um, I also think that, and contrary to what people believe, I think that the best time to buy a house was yesterday, and the second best time to buy a house is now.
Right.
A lot of people say, "Hey, well, I'm waiting for the market to crash." Well, they said that 4 years ago when we were in a pandemic, and all we saw is increase in prices. There's also, you know, an opportunity to take advantage of incentives now. If it's new construction, it's incentives to take advantage of the seller being able to pay some closing costs. If you wait, that doesn't mean you qualify later. What happens if you're waiting and Old Blue goes out and you need to buy a new car because you can't find a
Mhm.
motor for it? That's more debt you take on, and now you may not qualify for that $400,000 house. What if, baby girl's in college and she says, "Daddy or mommy, I'm going for my master's degree. I need a Parent Plus
Oops.
loan." You're
Yep.
taking out more debt. All of those things get calculated into it.
Right.
Um, I think people always ask me, Mike, when's the best time? When should I buy? Is when you can qualify.
Right. What if you
If
lose
you
your
don't
job?
qualify,
And that has happened. What
yep,
I had in 2008, I'm going way back. In 2008, we were supposed to close, let's say on Friday. And guess what happened to my buyers? They got
lost
fired
their
on Wednesday.
job.
He could never buy. But here's my 2 cents on why you should not wait. And I'm talking to the buyers or the sellers if you're thinking about selling and then buying. The way I see it, there's two things, and I talk about two clocks. You're absolutely right. You say you buy when you qualify. I say you buy when you are ready, willing, and able to buy. That means you're ready to buy, you're willing to buy, and you are qualified to buy. But here are the two clocks that I talk about. Whenever you buy real estate, it always long term. You're going to buy real estate to keep it for 5 years, 10 years, 15 years, 20 years. Whether you refinance or move, that's a different story. So whenever you buy a house, there's two clocks. One is the clock of your mortgage, which is typically 30 years. So if you're going to start your payment, start the payment today. That means if you start today, your 30-year clock started and you get your tax write-offs, tax benefits, blah, 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 right? The second clock is we know historically in the last 40 years, home price, and I'm talking about residential real estate, has gone up 4% on average every year for the last 30 years. Of course, it could be 6% if it's Southern California, or it could be 2% if it's Montana, what I'm just giving an example. So the second clock is start your appreciation now. So it doesn't matter what interest rate you pay right now, it doesn't matter what price you pay now. If you start the clock today, you're going to pay off your mortgage starting today in 30 years. And then your house that you bought for 600,000 today is going to be triple or quadruple in 30 years. So start the clock earlier, the better. That's how I look at real estate. And I know a lot of people who buy. I bought my house, this house that I'm sitting on. This is one of the rooms I made into a studio. I bought it in 96. It has more
Mm,
than tripled. And guess what? When I bought this house, I could not afford it. I was scared to death to buy it because my payment at that time was 1,500 bucks. I couldn't afford it. And today I'm sitting on a gold mine because I have equities almost paid off. And what
mm,
happened to me? Two things happened. One, I'm almost 30 years over. I've got 4 more years to go. So I started the clock early. And number two, my appreciation clock started in 96. And now my home has tripled in value. And that's the clock I'm starting about. So stop thinking about 0.25%. Hey, he got 6.2 and I'm getting 6.5. Don't worry about it. Or stop saying, hey, she bought it for 650 and I have to pay 675. It doesn't matter. If your house quadruples or triples, who cares about the 10,000 more that you paid right now? Think long term. Think ahead. Don't think now. That's what I say when it comes to not waiting, the effects of waiting. If that makes sense to you at all.
It makes a lot of sense.
Yeah.
Definitely, man. It makes a lot of sense.
Yeah. Yeah. Cool. Well, you know what? We're end of the day. Do you have any last comments to buyers or sellers regarding rates or what's going to happen in the next quarter when it comes to interest rates or financing, etc.?
Advice to buyers. Even if you're not looking to buy within the next 4 to 6 months, I would still apply somewhere to see how to get in position to purchase. And to sellers, same thing. Because you own a home doesn't mean you can buy a second one.
Okay. Yeah.
Now, when you purchased your home 4 years ago, you might have gotten 2 car payments, lost income, no longer working overtime, retired,
Hmm.
kid in school, or you went back to school. So if you're a seller and you're looking to see about purchasing a home, one, get with your agent, get with Mike and see if you can get a valuation on your home. Two, get with a lender to see how much you can qualify for to see if it makes sense.
Right.
If you're selling your home for $600,000 and you qualify for $600,000, is it a need to move?
Yeah. And on that note, if I'm a seller and if I don't want to move because hey, I'm set over here, I'm not going to move, but I have a lot of equity, then I may want to pull some equity, refinance, pull money out and buy a rental, buy an Airbnb,
Yep.
buy something and invest in another real estate property because you can't go wrong with real estate. Long term, you can never go wrong. Never, never, never. It's a gold mine. Long term, you'll never go wrong.
Right.
So
Awesome, man.
all right. Hey, thanks a lot. And if you're viewing this after the live, if you need a referral for a lender, for a realtor, for a credit repair, or any information, if you have any questions, put it in the comment. We'd love to see your comments or what you thought about this session or what you think is going to happen in the interest rate, how it affects the market. Let us know what you think. We value your opinion. Thanks for watching. And thanks, Kevin, again. And well, I'll bring you back to this in a couple of months and we can talk
All right,
more
man.
what happened. Thanks.
Appreciate the opportunity, brother.
Okay, thanks. Okay, bye-bye.
Bye bye.